Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Kulicke and Soffa Industries, Inc. quarterly report. Kulicke and Soffa Industries, Inc. offers a diverse range of businesses and services to various industries worldwide. At its core, the company provides capital equipment and consumables for assembling semiconductor devices such as integrated circuits, power discretes, LEDs, and sensors. The company operates through four main segments: ball bonding equipment, wedge bonding equipment, advanced solutions, and aftermarket products and services, APS. Under these segments, Kulicke and Soffa offers a variety of services including equipment sales, maintenance, repair, and upgrade. The company also provides tools, spares, and services for its equipment. In addition to equipment-related services, the company sells consumable aftermarket solutions and services. Its product offerings include ball bonding equipment, wafer-level bonding equipment, wedge and wedge-related bonding equipment, as well as advanced display, die-attach, and thermocompression systems and solutions. The company's customer base includes integrated device manufacturers, outsourced semiconductor assembly and test providers, other electronics manufacturers, foundry service providers, and automotive electronics suppliers. Kulicke and Soffa serves these customers primarily in the United States and the Asia/Pacific region. Kulicke and Soffa Industries, Inc. (KLIC) has experienced a significant increase of 65.35% in its stock price over the past year, driven by several positive news events. The company's strong financial results and optimistic guidance have been major contributors to this growth. In February 2026, Kulicke and Soffa reported first fiscal quarter 2026 earnings that surpassed analyst expectations, with revenue increasing by 20.2% year-over-year and adjusted earnings per share reaching $0.44. The company's upbeat outlook for the second fiscal quarter of 2026 further fueled investor confidence. The strong demand in general semiconductor revenue, which increased by 27% sequentially and over 90% from the same period last year, has also contributed to the stock price increase. Analyst upgrades and price target revisions have added to the momentum, with Needham & Company LLC raising its price target for KLIC twice in January 2026. Strategic investments and product launches have also positioned Kulicke and Soffa for long-term growth and expanded market access. The company's focus on innovation, including the launch of new products such as ACELON and Asterion PW, has been well received by investors. Overall, the combination of strong financial performance, optimistic guidance, and strategic investments has driven the significant appreciation in Kulicke and Soffa's stock price over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified by examining the trends in various segments. In the ball bonding equipment segment, revenue increased significantly by 85.6% due to higher volumes of customer purchases from technology transitions and improving market conditions. This growth is attributed to the increasing demand for advanced technologies. On the other hand, the advanced solutions and wedge bonding equipment segments experienced declines in revenue. The advanced solutions segment saw a decrease of 38.5%, primarily due to lower customer purchases in the lead industrial end market. Similarly, the wedge bonding equipment segment declined by 34.4% due to reduced demand from industrial and automotive markets. The general semiconductor segment, however, showed substantial growth, increasing revenue by over 90%. This growth is projected to continue, driven by regular advances in device performance and price declines resulting from improvements in manufacturing technology. Overall, the semiconductor industry's growth prospects are promising, with advancements in technology driving demand for advanced products. The financial performance of the company underwent significant changes between December 28, 2024 and January 3, 2026. Net income decreased by a staggering 79.4%, plummeting from $81,642,000 to $16,796,000. This drastic decline was largely due to the recognition of revenue in contract liabilities as of October 4, 2025. The profit margins also suffered a significant decrease. The gross profit margin dropped from 52.5% to 49.7%, while the comprehensive income plummeted from 71.6% to 10.7%. This decline was attributed to a decrease in provision for income taxes and an increase in effective tax rate. As a result, the company's financial performance took a hit, with net income and profit margins experiencing significant declines. Management is optimistic about the company's future prospects, outlining several key strategies to drive growth and profitability. A new share repurchase program will allow the company to buy back up to $300 million of its common stock, demonstrating confidence in its financial position. The company is positioning itself for long-term success by leveraging its research and development leadership and innovation. This involves investing in product development, pursuing non-organic growth opportunities, and returning capital to investors. Management is prioritizing core semiconductor assembly business opportunities and enhancing overall through-cycle financial performance. Management is also focused on allocating resources effectively, based on income from operations, and has outlined a range of strategic initiatives across segments, capital investments, and workforce planning. The company's existing cash and anticipated cash flows are expected to be sufficient for at least the next 12 months, providing a solid foundation for its growth plans. Overall, management is committed to driving long-term growth and profitability through innovation, investment, and effective resource allocation. The company has made several strategic moves through acquisitions and divestitures in recent years. In terms of acquisitions, there are no specific mentions of completed deals in the provided summaries. However, it is mentioned that the company is considering potential acquisition targets. On the other hand, the company has engaged in several divestiture activities. One notable example is the cessation of its electronics assembly (EA) equipment business, which is expected to be substantially completed by fiscal 2026. Additionally, the company plans to divest certain companies and has already disposed of a subsidiary for $2.6 million. The disposal of the subsidiary raises some ambiguity, as it could be considered either an acquisition or a divestiture, depending on the context. Nevertheless, the overall trend suggests that the company is actively managing its portfolio through strategic acquisitions and divestitures to optimize its operations and resources. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid out a significant amount of $10.7 million, as confirmed by multiple pages in the report. This indicates that the company values its shareholders and is committed to returning value to them. In addition to paying dividends, the company has also engaged in share buybacks, which have totaled $44 million over the reported period. The company's decision to buy back shares suggests that it believes its stock price is undervalued and wants to increase shareholder value by reducing the number of outstanding shares. Overall, these actions demonstrate a strong commitment to shareholder value creation. There are valid concerns about inventory buildup and supply chain disruption. The data shows a significant increase in inventory levels, from $160 million to over $176 million, indicating that companies may be holding onto more stock than necessary. This could lead to wasted resources and potential losses if products become obsolete or demand decreases. Furthermore, the high cost of logistics due to macroeconomic conditions, inflation, and labor shortages poses a significant risk to supply chains. The ongoing tensions in the Middle East and Ukraine/Russia conflict also threaten to disrupt global supply chains. Additionally, changes in trade policies between major economies like China and the U.S. create uncertainty and risks for companies operating globally. The inventory purchase obligations of over $297 million due in less than a year further exacerbate these concerns. With such a large amount of money tied up in inventory, companies may struggle to adapt to changing market conditions or unexpected disruptions. The heightened risks and uncertainties related to trade and export control policies also underscore the need for companies to be vigilant and prepared for potential supply chain disruptions. That concludes the financial summary for Kulicke and Soffa Industries, Inc. Feel free to comment below, and I will be happy to answer them when possible.